Welcome back to the deep dive. Today we've got a pretty hefty stack of reports in front of us. We're looking at the Q2 and H1 FY2026 performance for the Bajaj Finserv Group.
We are, and our goal here isn't just to, read out the earnings numbers.
Right.
It's to really get under the hood of this financial behemoth. We want to understand the strategy, the risks they're managing, and where they're placing their bets for the future.
Exactly. Because with a group this complex, you've got lending, insurance, tech. The headline figures can be, well, a little misleading.
They almost always are. You have to filter out the accounting noise and see what each part of the engine is actually doing.
Okay, so let's anchor ourselves. Let's start with the big consolidated view for the quarter that ended September 30th, 2025.
Good place to start. So consolidated total revenue was up 11% year over year. That's a big number. It hit 37,403 crore.
A very healthy top line. But what about the bottom line? The profit.
Well, and this is where we find our first bit of nuance right away. The consolidated profit after tax, or PT, grew 8%, so up to 2,244 crore.
So revenue grew 11%, but profit only grew 8%. There's a gap there. What's causing that compression?
That is the perfect question. It comes down to accounting volatility, specifically from their equity investments. We're talking about unrealized mark-to-market losses.
Okay, break that down. Mark-to-market. These are peeper losses, right? On stocks they own but haven't actually sold.
Exactly. It's a statutory reporting thing. It doesn't affect their actual cash flow, but it does drag down the reported PAT.
So the business itself might be healthier than that 8% number suggests.
Precisely. The reports are actually pretty clear on this. If you exclude those unrealized paper losses and instead you add in the realized gains, the actual cash they made from selling shares, the underlying profit growth was a much stronger 12%.
Ah, okay. That's a critical distinction.
Yeah.
It tells you the core operations are performing better than the market noise might suggest.
It really does. And before we get into those operations, there's a big structural update we need to mention.
Right, the Alliance stake.
The deal to acquire Alliance's 26% stake is moving forward. So the insurance companies formally changed their names back in early October. They're now Bajaj General Insurance and Bajaj Life Insurance.
And the first payment for that acquisition is expected soon. So more control, more flexibility for them in the insurance arm.
It's a formal step towards full ownership. Okay, let's dive into the core engines. Section 1, lending and housing finance. We're talking about Bajaj Finance, BFL, and Bajaj Housing Finance, BHFL.
BFL is it's a giant. The numbers are staggering. Assets under management, the AUM, grew 24% year over year.
Reaching 462,261 crore. I mean, the scale is just immense.
And their profit grew 22% to almost 4,900 crore. They added over 4 million new customers in just one quarter. It seems completely unstoppable.
It's a phenomenal growth machine, no question. But the most interesting part of their story this quarter isn't the growth, it's where they deliberately hit the brakes.
Oh.
Yeah, look at their credit quality. The gross non-performing assets GNPA is at 1.24%, which is solid, but they clearly spotted a problem brewing in one specific area.
Which was?
Unsecured lending to MSMEs. Micro, small, and medium enterprises. They saw credit costs in that segment starting to rise.
Meaning it was costing them more to manage potential defaults from those smaller businesses. So what do?
They made a hard cut, a really decisive tactical move. They slashed 25% of their new unsecured MSME loan volumes, just like that.
A whole quarter of their volume gone. That's aggressive.
It is. They basically said, we'll sacrifice some AUM growth to protect our credit quality. They're now projecting that segment will grow at a much more controlled 12 to 13% for the year.
So this wasn't a panic move. This was proactive risk management.
That's the key takeaway. It shows their systems are sharp enough to spot trouble early and act before it becomes a real problem. They're choosing long-term health over a short-term growth number.
That's a very disciplined approach.
Yeah.
Now let's contrast that with the other lending arm, for Bajaj Housing Finance or BHFL.
Right, the pure play mortgage business. They also had strong AUM growth, up 24%, and profit up 18%.
But their risk profile is totally different.
Completely different. BHFL is the super safe side of the lending book. Mortgages are secured, they're inherently low risk, and their asset quality numbers are just incredible.
How low are we talking?
Their GNPA is a razor-thin 0.26%, and their annualized credit cost, what they set aside for defaults, is just 0.18%. They actually claim that's the lowest in the entire industry.
Wow. So one business is making these sharp surgical cuts in a high-risk area, and the other is just built on a foundation of absolute rock-solid, low-risk assets.
Exactly. And that contrast really sets us up perfectly for our next section, where we look at the two insurance businesses.
Okay, Section 2, the newly renamed insurance arms. Let's start with Bajaj General Insurance. Gross written premium, GWP, grew 9% to over 6,400 crore. But the report flags this number as being complicated.
It is. There's a new IRDA mandate, an accounting rule, that changes how they recognize premiums on long-term policies. It's called a 1N basis.
So an accounting technicality is distorting the growth figure.
That's a great way to put it. The new rule makes the headline GWP number look lower than the actual amount of business they wrote.
So what's the real growth story here?
Well, the sources give us the key. If you strip out that accounting change and you also remove the really volatile government and crop insurance business.
The tender-driven stuff.
Right. If you look at their core business, the GWP grew a very strong 18%. And that is significantly higher than the overall industry's growth.
Okay, that paints a much healthier picture. And their profitability. PAT was up 5% of the combined ratio.
The COR, which measures their efficiency, stood at 102.3%. But again, if you adjust for that accounting rule, it was flat year over year at 101.4%. That puts them right up there with best in the industry.
Very solid. Now let's shift to Bajaj Life Insurance. This feels less like steady growth and more like a full-blown turnaround story.
It is. They call it their Bajaj Life 2.0 strategy. And it's all about profitable growth, not just chasing volume.
And the key metric to watch here isn't GWP, it's VNB, right?
Yeah.
Value of new business.
Absolutely. And their VNB surged. It was up a massive 50% to 367 crore in the quarter.
50%, that's huge.
It is. And the new business margin, the NBM, which tells you how profitable those new policies are, expanded by over 6 percentage points to 17.1%. They're calling it their highest ever VNB and NBM for a half-year period. The strategy is clearly working.
But wait a minute. I'm looking at their PAT, their actual bottom line profit. If the business is so much more profitable, why did their PAT just collapse? It went from 148 crore last year down to just 13 crore. That looks terrible.
And you've just hit on the most important learning moment in this entire report. The apparent contradiction is everything.
It looks like a direct conflict. VNB is soaring, PAT is plummeting.
It does. But the sources explain it. That plunge in profit was almost entirely due to a one-time regulatory hit, specifically a 112 crore impact from a loss of GST input tax credit.
So a tax technicality wiped out over 100 crore from their profit.
Yeah, that's it. It's a non-operational, non-recurring charge. And what's crucial for you to understand is that this short-term hit to the PAT does not reflect the long-term operational health of the business.
Which is captured by that soaring VNB.
Exactly. The VNB tells you the real value of the business they're writing today. The PAT just reflects a one-off tax issue from this quarter. The underlying business is very, very sound.
That context is everything.
Oh.
Okay, let's move on to Section 3, the emerging frontiers. These are the newer, smaller bets.
Right, the future growth engines. Let's start with Bajaj Finserv Asset Management, BFAMC.
Their growth is, frankly, explosive. AUM up 77% in a year. They're already at nearly 29,000 crore.
And they're not just a copycat. They're trying to build a unique identity with these specific investment philosophies like NQBE and focusing on megatrends. They're trying to stand out in a very crowded market.
Then there's the health tech play, Bajaj Finserv Health, revenue up 22%.
And their whole pitch is about integration. They want to be the one platform you use for everything. Outpatient, inpatient, wellness. They're trying to own the entire customer journey.
Okay, now for the number that made me do a double take. Bajaj Finserv Direct, their marketplace arm, revenue dropped a lot. It was down 47% to just 83 crore. That looks like a catastrophe.
It looks awful on the surface, doesn't it? But the context here is absolutely critical. This is a planned degrowth.
Planned? You plan to lose almost half your revenue.
You do if you're undertaking a massive tech overhaul. They were migrating their entire frontline sales operation to a new SFDC system. That's Salesforce.
So they knew sales would get disrupted while they changed the engine, and they just accepted the hit to the top line.
They did. They chose long-term technological stability and scalability over the sales numbers for 1 or 2 quarters. It reframes that 47% drop completely. It's not a failure, it's a strategic investment.
An investment in their future digital foundation. That makes sense. And they're still investing in new things, too.
Yep. They just incorporated a new venture, Bajaj Alternate Investment Management to get into early-stage equity and real estate funds.
Yeah.
Always building the next thing.
So let's tie all of this back to the big picture. Their overall strategy and ESG commitments.
Right. All these numbers we've talked about, the risk control at BFL, the VNB focus at Bajaj Life, it all comes from a few core principles.
Like continuous benchmarking, customer obsession.
And very efficient risk and capital management. You see that in the high solvency ratios across all the companies.
They also have some pretty serious environmental goals. Carbon neutral on Scope 1 and 2 emissions by 2032.
And they're already walking the talk. They produce more renewable energy than they consume. On the social side, the scale is just massive. The Bajaj Beyond program is a 5,000 crore commitment over 5 years.
With a goal of impacting 2 crore people. And you can see it in the numbers. BFL added 6.7 million people who were new to credit. That's real financial inclusion.
It is. And Bajaj General insured 19 million farmers. These aren't just feel-good statements, they're hard metrics.
Okay, so to synthesize everything, the core businesses, lending and insurance, are growing profitably, often because of these really smart, targeted strategies.
And they're taking the huge, stable profits from those core businesses and funneling them into these high-potential, but for now, high-burn ventures in tech, health, and asset management.
Which brings us to our final provocative thought for you to take away. The capital generation from the old guard, BFL and BHFL, is just immense. It's reliable. It's the engine.
But these new digital businesses, health, the direct marketplace, the AMC, they're absorbing that capital. We saw it with the Plan D growth. They require high-burn investment to scale.
So the question really becomes,
The question is this. Over the next few years, how does this massive group maintain the discipline and efficiency of its traditional financial powerhouse while also successfully funding the high-risk, high-burn journey of turning its tech-first startups into profitable, mature businesses in their own right?
it's that classic tightrope walk between sustaining the legacy and funding the disruption. A fascinating challenge.
It certainly is. We hope this deep dive gave you the context you need to connect the dots across this incredibly complex group. Join us next time for another look beneath the headlines.